Welcome to Easy Guides, step-by-step information. Please subscribe and hit the notification bell button. How to invest in the stock market. Step 1. Educate yourself. To start, you should gather a solid foundation of knowledge about investing and the stock market. Some key areas to focus on include a basic investment concepts. Learn about stocks, bonds, mutual funds, ETF exchange-traded funds, and other investment vehicles. Understand how they work, their potential risks, and potential returns. The fundamental analysis. Familiarize yourself with the process of analyzing a company's financial health, including examining its financial statements, management team, competitive advantage, and industry trends. See technical analysis. Explore techniques for analyzing stock price patterns, trends, and indicators to make investment decisions. See risk management. Understand the concept of diversification, asset allocation, and risk management strategies to help protect your investments. See investment strategies. Learn about different investment strategies, such as value investing, growth investing, income investing, and index investing. Understand how these strategies align with your goals and risk tolerance. Example: suppose you are interested in investing in technology stocks. Start by researching different technology companies, their financial performance, growth prospects, and industry trends. Learn about common valuation metrics, such as price-to-earnings P/E ratio, and how they can be used to evaluate companies in the sector. Start by reading some beginner-friendly books on the stock market. Some good options include The Little Book of Common Sense Investing by John C. Bogle, The Simple Path to Wealth by J.L. Collins, or The Intelligent Investor by Benjamin Graham. You can also take free online courses on websites like Coursera or Udemy to get a deeper understanding of the stock market. To learn more about reading stock charts, you can check out websites like StockCharts.com or ChartSchool.com. You can also read books like How to Read Stock Charts by Michael Kahn or Technical Analysis for Dummies by Barbara Rockefeller. To get a better understanding of how to analyze financial statements, you can read books like Financial Statements, a step-by-step guide to understanding and creating financial reports by Thomas Idelson, or Warren Buffett Counting Book by Preston Pysh. Step 2. Set clear financial goals. Setting specific financial goals will help guide your investment decisions. Consider both short-term and long-term goals. Examples of financial goals include a retirement. Determine the amount of money you would like to accumulate for retirement and the timeline you have in mind. The education. If you have children, estimate the cost of their education and when the expenses will arise. See major purchases. Identify any significant purchases you plan to make in the future, like buying a house or starting a business. Example: let's say your goal is to accumulate $1 million for retirement in 30 years. This gives you a specific target to work towards and allows you to calculate the necessary investment returns and savings rate required to reach that goal. Step 3. Assess your risk tolerance. Understanding your risk tolerance will help you determine the appropriate asset allocation for your portfolio. Risk tolerance is influenced by factors such as age, investment horizon, financial obligations, and comfort with market fluctuations. A conservative risk tolerance. If you have a low tolerance for risk and prefer stable returns, you may opt for a more conservative investment approach with a higher allocation to fixed income securities like bonds. The moderate risk tolerance. If you have a moderate risk tolerance, you may choose a balanced approach with a mix of stocks and bonds. See aggressive risk tolerance. If you have a high risk tolerance and are comfortable with market volatility, you may opt for a more aggressive approach with a higher allocation to stocks. Example: suppose you are a young investor with a long investment horizon and a higher risk tolerance. In that case, you might allocate a larger portion of your portfolio to stocks to take advantage of their long-term growth potential. Remember, risk tolerance is a personal decision, and it's important to find a balance that aligns with your goals and comfort level. Step 4. Create a budget and save. Create a budget. Start by tracking your income and expenses to gain a clear understanding of your financial situation. Categorize your expenses, including essential items like housing, utilities, food, and transportation, as well as discretionary spending like entertainment and dining out. Identify areas where you can reduce expenses and allocate more towards savings and investments. Build an emergency fund. Set aside an emergency fund that covers 3 to 6 months of living expenses. This fund provides a financial safety net, ensuring you don't have to rely on selling investments in case of unexpected events like job loss or medical emergencies. Step 5. Choose a brokerage account. Research brokerage options. Compare different brokerage firms based on their fees, account minimums, available investment options, trading platforms, research tools, and customer service. Consider whether you prefer a traditional full-service brokerage or a discount brokerage, which typically has lower fees but provides fewer advisory services. The account opening process. Visit the chosen brokerage firm's website or contact them directly to open an account. Fill out the necessary forms, provide identification documents, and fund your account through electronic transfers or check deposits. Example: suppose you choose brokerage XYZ, which offers a user-friendly online platform, has low trading fees, and provides a wide range of investment options. Visit their website, complete the online account application, submit the required documentation, and deposit funds into your account. Step 6. Develop an investment strategy. Determine your investment strategy. Decide if you want to invest in individual stocks, mutual funds, or exchange-traded funds (ETF). Each investment option has its advantages and disadvantages, so research each one to decide which strategy best suits your investment goals. Research stocks. Use tools like Yahoo Finance, Google Finance, or the brokerage website to research different stocks. Look for stocks that have a track record of growth, profitability, and a strong competitive advantage. Consider factors such as revenue growth, earnings growth, management team, and cash flow to evaluate a company's financial health. You can also read news articles or analyst reports to get a better understanding of a company's prospects. Plan for regular contributions. Decide on a regular investment schedule. Regular contributions, such as monthly or quarterly, can help you build wealth over time through the power of compounding. Example: suppose you decide on an asset allocation of 70% stocks, 25% bonds, and 5% cash. Within the stock portion, you allocate 40% to large-cap companies, 30% to mid-cap companies, and 30% to international stocks. This allocation aligns with your risk tolerance and provides exposure to different segments of the market. Step 7. Conduct research and select investments. Fundamental analysis. When researching potential investments, examine a company's financial statements, such as balance sheets, income statements, and cash flow statements. Evaluate key financial ratios, like price-to-earnings P/E ratio, return on equity ROE, and debt-to-equity ratio. Consider qualitative factors like the company's competitive advantage, industry position, and management team. Technical analysis. For those interested in short-term trading or timing entry and exit points, Consider using technical analysis tools to analyze historical price patterns, volume trends, and various indicators. See diversification. Spread your investments across different companies, industries, and geographic regions to reduce the impact of individual stock or sector volatility on your portfolio. Diversification helps mitigate risk and potentially improve returns. Example: suppose you are researching a specific technology company. Analyze its financial statements to assess revenue growth, profitability, and debt levels. Evaluate the company's competitive position in the technology industry, its product portfolio, and any recent news or developments that may impact its future prospects. Consider analyst reports, industry trends, and the company's long-term growth potential. Based on your analysis, you can make an informed decision about whether to invest in the company. Step 8. Execute trades and monitor your portfolio. Placing trades. Once you have selected your investments, log into your brokerage account and place the necessary buy or sell orders. Specify the quantity of shares or dollar amount you wish to invest. Review the order details carefully before submitting. Monitor performance. Regularly review the performance of your investments. Use the tools and resources provided by your brokerage account to track the market value of your portfolio, monitor news related to your investments, and stay informed about any significant developments or changes in the companies you've invested in. See rebalance your portfolio. Periodically review your asset allocation and rebalance your portfolio if needed. Over time, certain investments may outperform others, causing your asset allocation to shift. Rebalancing ensures that your portfolio remains aligned with your desired asset allocation and risk tolerance. Example: suppose you decide to purchase shares of the technology company you researched. Log into your brokerage account, enter the details of the trade, such as the number of shares and the limit price if desired, and submit the order. Afterward, regularly monitor the stock's performance, read company news and quarterly reports, and consider adjusting your investment strategy if circumstances change. Step 9. Stay informed and learn continuously. Market news and updates. Stay updated on market trends, economic indicators, and geopolitical events that can impact the stock market. Read financial news publications, follow reputable financial websites, and consider subscribing to market newsletters to stay informed. Investment education. Continuously expand your knowledge about investing. Read books, attend seminars or webinars, listen to podcasts, and participate in online communities where you can learn from experienced investors and share insights with others. See review and adjust. Periodically review your investment strategy and performance. Assess whether your investments are meeting your financial goals and make adjustments as necessary. Regularly reevaluate your risk tolerance and ensure that your investment strategy remains aligned with your changing circumstances and objectives. Example: stay updated on financial news related to the technology sector and the companies you have invested in. Read industry reports, attend technology conferences, and follow influential figures in the field. Consider joining investment communities or forums to exchange ideas and gain insights from fellow investors. Remember, investing in the stock market involves risks, and there are no guarantees of returns. It's essential to continue learning, adapt your strategy as needed, and consult with a financial advisor if you require personalized guidance.